When you first start investing, it can feel overwhelming. There are so many options: stocks, real estate, mutual funds, gold, ETFs, and more. It's easy to get lost and confused. When it comes to investing, the numbers don't lie. Here are the average annual returns over the past 50 years for different asset classes. Stocks, S&P 500, 10.5%. Real estate, 6.5%. Bonds, 5.8%. Gold, 6%. Cash savings, 2%. So, where's the right place to begin? For most investors, you only need to focus on two main asset classes: bonds for short-term stability and stocks for long-term growth. Let me explain why bonds are for short-term. Bonds offer predictable income and are generally less volatile. If you need the money in the next 1 to 3 years, say for a house, education, or emergency fund, you don't want to risk a big market drop. That's where bonds help. They can preserve your capital and give you steady returns. Investing in U.S. government bonds is viewed as nearly risk-free when it comes to the payment of interest and principal. Now let's talk about why you should invest in stocks for the long term. Over the past 50 years, the stock market has outperformed every major asset class. Stock investing is the smartest decisions you can make for your future. A stock represents ownership in a company. When you buy a stock, you're buying a small share of that business. As the company grows, earns more profit, and increases in value, your stock becomes more valuable. If the company pays dividends, you'll also receive a portion of its earnings. But here's the catch. The key word is long-term. No one can predict whether a stock will go up or down tomorrow, or even next year. Market moods swing wildly. One day it's fear, the next it's hype. But over time, stock prices follow real business value, and great businesses grow. Investing short-term in stocks is speculating. Investing long-term is wealth building. So how long is long-term? Warren Buffett said it best: if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. There are two ways to invest in stocks. 1. Index investing, which is a passive strategy. Invest in a low-cost index ETF like VOO or VTI. You own a diversified portfolio of hundreds of companies. It is low risk, low effort, and for long-term growth. Perfect for beginners and hands-off investors. 2. Stock picking, which is an active strategy. Pick individual companies based on your own research. Potential for higher returns, but requires deep knowledge and discipline. Best for experienced investors who enjoy analyzing businesses. What are the other benefits of bond and stock investing? Liquidity. Thanks to the advance of technology, bond and stocks can be easily bought or sold on brokerage platform, unlike real estate or private businesses. Every trading day, millions of shares and bonds change hands, and thousands of people buy and sell in real time. This high volume of activity means you can enter or exit the market whenever you need. Low transaction cost. Trading fees are extremely low or even zero. You can invest without worrying about costs eating into your returns. Compared to paying thousands in agent commissions and legal fees when investing in real estate, stock trading fees are practically heaven. Accessible to everyone, you can start with any capital. Investing is no longer just for the wealthy. With modern brokerage apps, anyone can create an account and start building wealth from anywhere in the world. Passive wealth building. No employees, no operations, no stress. You're not running the business. You're simply an owner. You can invest in companies led by the world's best CEOs and management teams, letting their expertise work for you. While you sleep, your investments keep working. That's all you need. Build with stocks, protect with bonds. Start early and let time do the heavy lifting. If this video brought you value, give it a like, share it with a friend, and subscribe for more investing wisdom. This is Invest with CY, and your journey to financial freedom starts now.